using that in meetings. And I think all the farmers need to get together and chip in to pay for that because I am single-handedly put an end to the drought here in eastern Nebraska.
I see some familiar names popping on. Welcome, Brad, Joey, Staten. Staten's repping the great state Commonwealth of Kentucky. Sorry, Staten. Nicole, you're here from Central Illinois. There's a Sterling down this way. There was some anhydrous put on yesterday in extreme southern Illinois and in western Kentucky, so it's officially underway. I think we're going to get rain to douse everybody's enthusiasm here over the next 24, 36 hours, but we did get officially started around here.
Yeah, we're still quite a ways away. It's going to be rainy, dreary, and cloudy and cold really for the next 2 weeks. But then I think things should start to turn around a little bit. But right now it's London weather.
So Sterling, I came loaded for bear today, okay? And I have collected a lot of, we went to the Commodity Classic last week, so it was a good show. Camaraderie was good amongst cohorts, and we saw a tremendous number of farmers and kind of we didn't talk to a lot of agents, of course, because it is sales season. And I think the longest day of the year is March 15th for a lot of folks. And we did talk to a lot of farmers down there, and came loaded with a lot of good questions for this meeting. So you better be prepared because I'm going to fire from the hip today.
Okay, I am fully prepared, and we need to talk about any of the other business that's been going on the last a couple of weeks. I'm fully equipped to talk about that too.
So Sterling, if I see any cash in the background, I'll know what the banking crisis was all about.
Yeah, if you start to see me piling things up here and increase my collection of gold bars, banking crisis might be, well, it's good for clicks on the internet. That's what it's good for. As everything that I've been able to discern, and since these were publicly traded entities, I've been able to look under the hood very closely. This appears to be a case of bad bankers and taking risks and not necessarily fully understanding what goes on when interest rates go up. And some of it I can blame the bankers. Some of it I can also blame on none of them have really had to trade an interest rate environment where the value of the bonds actually changed direction much. We've seen bond prices continue to go up really for the last 40 years and interest rates go down. So if you're trying to trade a market where you're dealing with bond prices falling, it's a little bit different, and they've not really had much experience really in dealing with it, and certainly not on the magnitude to the level that we saw with the amount of the Fed rate hikes. So we should probably save this until we get started.
Yeah, it's too good to unveil. Well, on that note, just small talk before we get started, I think a lot of us are seeing some changes even in our local primary ag banks. And, one thing that especially where, Staten's from, well, really everybody on here, Nicole, I was thinking about everybody where we're at. We think about our local banks being primarily ag banks. And one thing, I think there was a trend probably 5-6 years ago, right after we got out of that really good market in 2012, 13, there was a trend for as much as possible small town America bank to try to diversify a little bit out of such a heavy ag book. And so we've seen it here, which, I think a lot of us kind of criticize that move a little bit because ag is the backbone of most of our local economies. But when you see something like this hit, you start to understand that they were doing the right thing. And today I see those same banks or what they call building up the bank. And so for the first time, they're able to go out, put money in CDs for a long time. That's appealing to people. So I've got faith in the banking system all in all. I think this was I think like you said, this was a bad banking example more so than something that's epidemic across the industry.
Yeah, it was a failure to understand risk combined with there's two kinds of positions in life: not enough of something or too much of something. Those are the only two things. And when we talk about interest rates here, I can explain real clearly what exactly happened to these banks and why it's important not only for everyone to hedge their risks, but banks need to hedge their risks. Because what happened basically was just like if you had a grain elevator, you were at CGB, that grain comes in, what's the first thing you do?
Hedge it.
You
Well, we
sell
hedge
it
it when we
futures.
buy it.
Yeah,
Yeah.
yeah, not even before it comes in. As soon as you have an obligation, you offset that risk. Well, the same thing happens actually in the banking world. Not to the exact, you don't necessarily want to exactly match your yield curve, but you need to lay off some of it in the event that prices go down. Well, we had all this craziness in the 2-year note that made it very sexy to buy, but then rates spiked, and all of a sudden, you have a mark-to-market problem.
Yeah. That's a very, very good point, that hedging example, and that plays so well into not just banking but running a business. And this time of the year, my wife spends a little time working on taxes and for farmers, and we've got to get better. We got to get better as farmers at running a business. She can attest to that when she gets kind of boxes full of receipts that come in. But we're going to learn. I'm afraid over the next year or two, we're going to learn about hedging on the farming being pretty important too. Well, we're almost there. Ashley, are you unmuted?
Yes, I am.
All right. I don't have a record button. Do you have the ability to start a recording
Yes.
here within a minute?
Mine automatically records, so we are good to go whenever you guys are ready.
All right. Well, we're getting several that popped on here at the very end, and I think I really think this is going to be one of our better meetings. So I'll kick it off officially. I want to welcome everybody out to the March ASNA Edge marketing meeting. And while we're in the doldrums of the markets, if you haven't been able to tell, just take a look at wheat futures, corn futures, soybeans. We're at a time of the year where there may not be much that impacts the number of corn and bean bushels on the globe. In other words, we're not right in the middle of a key growing season. We're on the cusp of planting, but there's not that risk factor that there is in the United States in June and July. There's not the risk factor that there is in South America in December and January. So a lot of times we look at some outside factors. And if you joined us early, you heard Sterling and I talk about the banking issue. We're going to talk about how that could possibly carry over into our markets in a little bit. But as mentioned, our team just got back from the Commodity Classic. We talked to a tremendous number of farmers down there, collected a lot of questions. The other thing we've just got done doing is Sterling and I do a lot of meetings for farmers and agents during sales season. So I think, Sterling, I've been to 16 states over the last 2.5 months. I don't know what your count is up to. You've been fairly local out there, but I know you've probably been to 5 or 6 for sure, haven't you?
Let's see. I've been Nebraska, obviously, Iowa, Minnesota, and Kansas, but most states multiple times. So,
well, Sterling, I mentioned I'm going to fire from the hip today, and we've got more people joining us as we speak. Wayne from Ohio just popped on. Raymond, thanks for popping on here. Joey, thanks for listening. What we want to talk about today is what concerns farmers out there. And I think the main thing is we jump into this thing, Sterling, today with a snapshot of where our markets have, what they've done over the last month. While I talk here over the next few minutes, would you be willing to pull up some charts on corn, beans, and wheat for us?
absolutely. Do you want old crop or new crop?
Let's look at old crop, because I think that we'll talk new crop here in a second, but for old crop, there is a sense of, oh boy, I missed the market. And there is a tremendous amount of old crop corn that is not marketed. So I want to spend a little bit of time, first of all, talking about old crop corn. This is for the farmer that has corn in the bin that's not sold, maybe corn on DP. They've passed up some really good levels between harvest and now. A lot of these folks are not necessarily wanting to move the corn during planting season. So if it doesn't move in the next 2 or 3 weeks, which if you know a farmer, they're going to try to move some out before they get in the field. It's probably going to be sitting there until June and July. So, Sterling, let's talk to the farmer right now that has old crop that has to move it the next 2 or 3 weeks, maybe 5 weeks before they get in the field planting. Boy, it feels like they're stuck here. Give us a rundown of what the market's done.
Okay, Brooks, can you see my chart here of May corn?
Yes.
Okay, as you can see, prices we were holding up fairly well, 650 being kind of the low, 680, maybe we touched $7 once in a while, but we were pretty much caught in this range. What happened right here, and I want everyone to pull out their notebook and I want you to write this down. The end of February, not only is it the insurance pricing period, it's when the March futures come into delivery. And what happens if you're long in that situation, you need to get out of the market. Now, most of the fund longs that were in the market were concentrated in the front end of the market. And as you can see on this chart right here, as we come into the end of February, we have the hallmark of fund selling right here. It starts a little bit, and all of a sudden, oh, I'm losing money, out I go. Oh, I'm losing money, and they liquidated a large amount of their positions. I know we haven't had COT reports to get the exact numbers on this, but I can look at open interest, and when I see aggregate open interest drop and prices come down, that means long positions are being liquidated. That's the only thing that can make that happen. So keep in mind for next year, we should expect a counter fund position move in March, meaning if the funds are short, they may be willing to come in here and buy and cover those positions. They can hold shorts a little bit. And the next question, are they going to want to roll that into the next crop year or even out into July? And what happened here, the funds liquidated and that pushed corn prices down noticeably. They did not want to extend their new positions because we have two things driving that. Number one, exports aren't that great. We did have another week of good export sales this week. There is a chance they can improve. The other bigger item is it's Brazil. It's Brazil, and it's real, and it's going to happen. You know, we're looking 152 on beans. We're looking 125 on corn. It's going to happen. Don't even take any hope to the bank. That the corn crop isn't quite made yet, but things are fine, and the bean crop is certainly made. So
let me add a little color to this, Sterling. I know we got some first-time visitors on the call, and want to welcome Dawn and Anita to the call. I know you guys got on there just a little bit late. What Sterling's talking about right here is if you follow our weekly email, our Fridays have been largely absent for the last few weeks because the commitment of traders report is not out there. That would relate to the fund buyers and sellers or the speculators in the market. And for over the last, Sterling, 24, 36 months, corn funds have been extremely long. That length is coming down just a bit. Sterling did a great job on Wednesday's daily market email to show where those funds set on corn. Now, if you remember back in previous years, we used to have something called the action indicators. And the action indicators, they looked at the fund position like a fuel tank. And typically, when that fuel tank is full or when those funds are long, that's when the farmer wants to be a seller. As they come down and as they go below that half point where they're almost empty, that's where typically you want to be a buyer. And right now, where we're at is that fuel tank has been full. And like Sterling indicated, at the end of February, beginning of March, as delivery periods come on that March futures, we're seeing a liquidation of those. Now, Sterling, I'm going to switch gears because you were going here. But we switch over now, and while fund buying and selling is fundamental to the market, it impacts a lot of technical moves. So you mentioned triggers a sale, triggers a sale, triggers a sale. You do some analysis on these charts, and what I like about the daily email is you make it where everybody, even a guy like me, can understand what's going on here. Tell us a little bit about the technical move before we get into the fundamentals of exports and what's going on in China. Tell us about the technical move that's occurred.
Okay, I'm going to draw a line right here on my chart here. We had pretty good trend line support kind of coming through right here, and we broke through that. Now notice we had a little bit of a rally, managed to push up. We touched that support area, we bounced, and more failure and trouble, and we're making a bit of a recovery now. But this line comes in right about 643. That's your point. If we get up, you see the board at 643, that's when you need to be getting concerned. That's when I'd be definitely, if I had something to sell and the basis is good and you don't think your basis is going to get any better, that's when you're probably going to see some pressure. But you don't want to do everything at once because we could potentially bounce up through there. Now, are we going back up here? I doubt it, unless we have meaningful weather problems or a really change in tenor in China about buying corn. We'll come back up here, we'll test a couple of these moving averages, and we're probably going to start sliding back, and that may give the funds an opportunity to do something that we haven't seen in the last 36 months. We've seen funds being net long market participants. That is supportive to prices. They're in here buying futures contracts. That lifts prices. Funds are fully capable of being net short market participants, fully capable of doing that. And if we get a situation where right now we're kind of in a risk off mode and things are a little bit nervous because of other things, that goes away. Funds might start turning into sellers, and that's when we start seeing prices really get pressed.
So one thing that we're in a transitional period here. We've seen most of the volatility occur in nearby or old crop futures months over the last 6 months. We are slowly transitioning that volatility to new crop. So suddenly when Sterling talks about weather issues, weather issues largely are not going to impact old crop stocks. Sterling, do you care to pull up the latest WASDE numbers on corn? And as he does this, so that spread between old crop futures and new crop futures has been very wide. Very likely we start to see that come together slowly at first, faster later on. And of course, weather is going to be the biggest determinant of that. So back to the question, we do have one answer here, and that's look at 643. We like that futures level for old crop numbers. Basis levels are really, really good. In most parts of the country, they're positive. There's a few pockets where you'll see some negative, but any place around processing plants, things look really good. Ethanol is strong. As you can see on here, the very bottom line of the chart, you see ethanol, 5.25 billion. Yeah, that's a tick lower than maybe where we were at last year and the previous year, but still good. You look at our domestic feed, and it's almost a mimic of that number. It's 3 from the bottom, 5.275 billion. That's the corn we put into our flocks and herd. Demand's really good. So we got two bright spots. Here's the problem, and it comes in exports. Exports dropped to 1.85 billion bushels. Now, if you had been on these meetings the previous 3 months, we have telegraphed that this was most likely to happen. We start back in December where the number's about 2 billion. We come down to 1.9. We set there really through February. We've dropped to 1.85 billion. And while this is a small number compared to our ethanol use and our feed use in the U.S., it's also the most volatile. Let me tell you how volatile it is. 10 or 11 months ago, had you been on this meeting, expectations were strong for exports. Some estimates were that 1.85 billion could be as high as 2.55 billion. Okay, Now, I don't want to exaggerate a number, but had we come in at 2.55 billion, Sterling, what is your price for corn today if those exports were 2.55 billion?
Oh, we could easily put another 25 to 40 cents in the market easily.
Pretty easy. I would think maybe that might be low. I think maybe we could even be higher than that. I'm not so sure that we wouldn't test some really, really strong numbers on corn. But let me kind of explain why this has happened. Sterling, I want you to tackle what's going on with China in corn, and I'll tackle what's going on in Ukraine. Tell us about your accumulated corn exports and why that 2.55 billion has shrunk to 1.85.
Okay, this is accumulated corn exports for each year. And I like this number because sales can get moved around, sales get canceled, but this shows what we actually have gone out the door. Now, this is our total corn exports right now. This blue line is the 5-year average. This red line is where we're at right now. So as you can see, we are trailing under. And then when we go and we look at what's going on with China and what we're sending to China, which I put these charts in every Thursday, and you'll see them today, and they'll be updated, and you can follow them at home and try to make the picture as easy as I can. This is our accumulated corn exports to China. The red line right here, as you can see, we have more or less, we're getting back down to the 5-year average here. We're not tracking with the 2 solid years. Historically, we don't send corn to China, or much. And it appears that we are starting to level off a little bit here. And if this continues and China buys corn from South America, which they said they're going to do, and I don't always believe everything that comes out of China, but I'm going to believe this one, this number is probably going to end up not really going up much for the rest of the export season for old crop.
So we got a China issue. Sterling, I'm going to share my screen very quickly and talk about the other, the issue that's out there. Give me a thumbs up when you can see this. Let's see. Yeah, I think am I up there now?
It says you're starting to share content.
All right, well, it may take a while. I'll pedal a little faster here. All right. Can you see that screen?
No, it still says you're starting to share content. There may be an icon floating on your screen that says share this content.
Well, let's take a look. I'll talk while I'm trying to trying to troubleshoot this just a little bit. But essentially, you still with me there?
Yep.
All right. I've lost my whole WebEx completely. Let's see if I can find you again. Still there?
Oh, we're still here, but it's
all right. Well, I'm going to have to talk through this because I don't see anybody anymore. Essentially, we got a situation in Ukraine, and 12 months ago, if you've been to one of my meetings, you've seen in Ukraine that we were unsure how much corn they'd get planted last year. Now, the one thing that we kind of forgot is the war started last February, and there was a fair amount of old crop corn left over in Ukraine. This was corn that was planted in 21, and it never got to market in the summer months of 22. So we started off with corn in the bin. We planted a crop, which was surprising, the number of hectares I could show you here if I could find you guys again. But we planted a fair amount of corn, about 80% of the acres or hectares that we planted the previous year. And surprisingly, the news reports of farmers not being able to get in the fields because of landmines obviously was an exaggeration because they harvested a crop. Granted, it wasn't a great crop. What's probably more amazing than the Ukraine farmer planting this crop is it's made it to market. Now, in a peaceful, perfect year in Ukraine, we count on them for about 1.3 billion bushels of exports. So kind of compare that with where we're at in the United States at 1.85 billion. They're big. They kind of go back and forth between the world's number 3 and number 4 export supplier, but a pretty sizable amount. how many of those bushels got to market? That was the question that the market really didn't know the whole year. And all of a sudden, when September and October hit, it was surprising how many of these bushels left the Black Sea. They're primarily leaving the Black Sea, also by rail into Eastern Europe, but the majority of them through the Black Sea. October was a pretty good month, around 2.5 million metric tons. It stepped up in November. It continued its pace a little faster in December. In February, proved out to be a tremendous export month. We had some buyers that are traditional buyers out of Ukraine. They just usually don't buy until July and August. They stepped in and bought a tremendous amount in February. Now, initially, Sterling, my thought was, well, you know what? They know something's up. They know the Russians may take out some of these port cities. But I think what it's boiled down to is they were a little bit concerned about quality. They wanted to get in line a little bit earlier. Those were countries like China, Japan, South Korea that normally hold out and don't buy that Black Sea grain until later on in the year. They stepped in and they bought. Okay, right now, assuming no disturbances to the shipping line, assuming that they can ship out at least number 3 yellow corn, they're on pace to get as much as 800 million bushels shipped into the world. And when you use that number, how much did I think they were going to get shipped out? I watched the news just like everybody else. I thought maybe 0 to 200 million bushels. So they've surprised the world at how much they've gotten out. So these two factors, our number one buyer from last year slowing down tremendously in China, also Ukraine kind of coming out of left field with some bushels that a lot of people didn't anticipate into the market.
Oh, I would definitely agree. My concern, and this is one of the things as I, build my bullish case, my bearish case, and try to balance out and get a reasonable idea of what's going on. There was acute trade, obviously, when the Ukraine was invaded and wheat prices exploded and everything went up. They still had grain on hand. Russia had a big crop. The Russians are still in the Ukraine and they're still fighting. They're still destroying infrastructure. We may be not having the market trading an acute problem where we may have a more chronic situation here where perhaps this year for corn and wheat in the Ukraine, acres planted are going to be smaller, fertilizer is going to be an issue, harvesting, quality, things like that may start to tighten that supply to what the market anticipated a year ago, which, a tail risk, which futures markets and grain markets aren't always that great about appraising tail risk. And I've got something to really show you about tail risk here in a bit. But that is something where we may see, this, treasure chest of grain that we saw coming out of the Black Sea, that may start to tighten up a little bit.
Well, I'm trying to rejoin. I think I was without you.
We see you, Brooks. We don't see you, but we see co-host. There you are. Can't hear you.
You're muted.
Need to unmute yourself.
All right, we'll try that. I'm
There
having
you
all
go.
kinds of
There you
technical
go.
issues
You're
today.
good. You're
Too
good.
many
There you go.
applications open. I'm afraid. I apologize for the technical difficulty. Let me go over this with you real quick as far as where Ukraine's at. I like I said, I think you had me by audio for just a bit, and
There you go.
what we're seeing here is in a normal year, you've seen this one from me before, 42 million metric tons of corn produced in Ukraine. About 3/4 of that is leaving the country, which is around 1.3 billion bushels. Now, some information that came in, and you guys are going to be some of the first people to hear this from satellite companies right now, is one thing that may change these planted hectares for next year is that, I'm going to go back to the map for just a second. See if I can get it there. This eastern corridor in Ukraine is, we believe that the crop may be in jeopardy here over the next 2 to 3 months. So as many as 26%, according to the satellite company that I got information from, of this country may very well be not able to plant. Now, this is primarily wheat country. Your crux of your corn is going to be along this Dnieper River. So it's almost kind of like a big V throughout the country. The majority of the corn is going to be grown in the central part of the country along that river valley. And so it's a big question. We're going to have acres that are impeded by this war. I would call it occupied territory, but just not the ability to get the crop out, probably more so than we saw last year. Also, keep in mind, we don't have these old crop stocks. So if you look at this, going 21-22, we had 9.1 million metric tons of ending stocks. They were left over, kind of forgotten corn in the country. We came in, and to illustrate what I said earlier, we planted around 4.5 million hectares and still have a reasonable amount of corn left over unless it can't get to market. But I apologize for not being able to illustrate that earlier. And Sterling, we'll kind of get back at it. But I think we've done a pretty good job of kind of illustrating what's going on in the corn market. And if you've got old crop corn, take advantage of that basis. We know that's good if you got to move it. I like that target number of 6. I probably wouldn't tempt fate at 643. If you can get close, I think it's a pretty good time. And you got to move that corn before planting. You're going to be okay there. If you wait until the summer months, all the stuff soybean demand is really good. And Sterling, do you care to pull up a soybean chart?
I'm punching that up right now as we speak here.
If you could trade spots with somebody in the U.S. today, you want to trade spots with someone who owns a soybean processing plant. Soybean processing plants are doing very, very well right now. Board crush, and we call the money you make in soybeans, we call that crush margin. If you're a processor, as you crush soybeans, they've been outstanding. And as I sit here and I tell you how good demand is, which we're going to illustrate it here in a second, Sterling, why in the world have we sold off a little bit on soybeans over the last 2 or 3 weeks? I'm looking at these crush margins being awesome. Exports, I know there may be a smidge disappointing, but still pretty good. What gives on soybeans?
Well, if we look here, you can see the chart of crush. Is that the chart you're seeing? Okay, as you can see, crush margins, historically, this is just for May, but normally, 140-ish is, pretty good. We got all the way up to 220. We spiked hard. And, well, like anything, the cure for high prices is high prices. We popped up here. We've seen here really over the last 10 sessions, crush margins have come in. They're still very elevated and they're very good. That's what's keeping the soybeans from really getting beat up here. And I can switch over to the soybean futures. We've seen soybean futures are starting to flatten out a little bit. One, these supplies are going to start getting tight. We're running lower on soybeans. If you look at export inspections and things, normally we see a big seasonal decline. This is going to start tightening up. The other thing is we've seen some surprising things in crude oil. What's driving the crush margin is not meal so much as it has been the soybean oil. We have this new biofuel mandate, and this is going to be very good for soybeans, and it's going to probably work to offset some losses that we're probably going to be seeing in ethanol, 2 or 3 years down the road. So this is what has helped keep certainly nearby soybeans, noticeably stout. Soybean supplies are inherently tight even globally. So there's always, good demand for soybeans. Our export pattern, what we're sending to China is good, and I'll pull that up here in a minute, but we're doing a better job sending it other places. We're also going to become a better soy meal exporter. Argentina always has problems. Once they start buying U.S. meal and they find U.S. meal does have some inherent advantages in the way the amino acids work, I think soybean meal exports, if you can't change places with the guy who runs the crush plant, maybe you become a commercial meal exporter, because I think we're going to see a lot of opportunities globally for that develop over the next 5 years.
I think that's a really good point. Kind of back to your crush margins. At one point in time, about 2 weeks ago, spot crush margins. Now, this would be circumstantial. This would be buying beans at spot price, selling oil at spot price, selling meal at spot price, or actually over $3 a bushel. Kind of put that in perspective. Now, Sterling, one thing I think that we've talked about this again for 3 or 4 months. So why in the world, our crush numbers on our WASDE report have actually trickled just a smidgen lower month on month. Now, I think they popped up a bit on March, but how in the world does a crush number come down if you can make $2.50 to $3 a bushel? Tell us why that happened.
Number one, you only have so much capacity. You can only smash beans so quickly. I think the USDA may have gotten a little bit ahead of themselves. And two, you have to come up with the beans. If you don't have any beans nearby, all of a sudden you're going to have to buy them. If I run a crush plant in central Nebraska and I've used up all my local beans, suddenly I need to get those beans from Minnesota or maybe from Iowa. And that starts to get a little bit cost prohibitive.
I think that's a really good point. And if you talk to an adjuster on the AgriSompo North America team, they can tell you they know Kansas and Nebraska very, very well this year. The preponderance of our 120-some thousand claims this year came from that western belt, from Texas all the way up. And we called it, back in the January meeting, I think we called it dislocation of soybeans. So, number one, if you look at that carryout of 210 million, again, I'm going to exaggerate a bit, but it's essentially like we're out of beans, okay? 210 million beans spread across the country. You think about this: bin bottoms and processing plants, bin bottoms and commercial elevators that may not get cleaned out. When you got 9% beans, 9% moisture beans in the bottom of a bin, you're not in a big hurry to clean those out going into new crop if you're an elevator manager. So these beans, they may be in transit someplace. It's essentially like having zero. And I know that's an exaggeration, and I can be criticized for that. But if you are running a crush plant in Emporia, Kansas, which I believe there's one there, it's going to be a challenge. It's going to be a challenge to get through the year. You can't turn on a crush plant like a light switch. You can't say, today I'm going to crush, tomorrow I'm not. So you start to ration. And then, the flip side of it is if you're in Mankato, Minnesota, you may have some excess beans. Where I'm at in southern Illinois, southern Indiana, we got 3 processing plants on the Ohio River within 110 miles of where I'm at. Those folks are probably going to ration a little bit too. I see beans getting very, very tight. What's that mean for you if you're in these areas? It means they're going to be very hungry for soybeans late summer. You're going to see some basis levels that maybe we've never seen. So just think about this. If you're a processing plant, you've got these crush margins where they're at, like we told you, what can you expect on basis? You can expect a big basis. Does that mean futures are going to be there? Not necessarily. So, you want to be careful holding off into the summer to play that basis. Some of you have gotten really good premiums for early season soybeans. So if you could get soybeans to market, if you're in the Delta late August, if you're in the lower Midwest, the first part of September, we got to watch that really, really close. And here's one reason, Sterling. We've had a little bit of a delay in harvest in Brazil. And that delay, it for most of us, we think about what it does for us here and now. Essentially, we picked up some later exports on soybeans that we might not usually have had Brazil not had a little rainy season. But the problem is those beans are still there, and they just simply come to market a little bit later. So it's March. I know we're talking about something that's going to happen in September. Be very careful about being super aggressive on those September premiums that you can get for maybe your early maturity beans. They may not be there because Brazil may be filling that export void. Any comments on that, Sterling?
Couple of things. One, here, this is a chart of soybean export inspections. And as you can see, we have a big seasonal, things tank until we get into the fall. Thing here, and if we look at soybean exports to China here, very quick here, accumulated exports to China. You can see there's a curve here. We go great guns, great guns, great guns after harvest, and we get to about February, this line goes sideways and doesn't really go up. This looks a lot like our accumulated export chart, but we may see a little bit of improvement. But as far as China goes, we're at 28 right now, 30. So we may, we're not looking at that much more going to China, really. We'll be lucky to match the light green line here in terms of, total exports, but then, or exports to China. But then when we look at total exports, accumulated exports for soybeans, we actually had a pretty good curve here. This is going up, and maybe, just maybe, if we can go a little bit better and we can add some meal in there, maybe we can see a pretty good year for exports. But that's something. And one other item, I would not be surprised to see farmers, especially in central to eastern Nebraska, western Iowa, be aggressive about planting soybeans first.
So you would or you would not, Sterling?
I kind of expect them to do that.
I do too. At the Commodity Classic last week, I went to an agronomist, and they jokingly said, for essentially the Southern Corn Belt, have your beans planted by April 15th. Now I'm just quoting this agronomist, but the point is these early planted beans, and I've been one of these naysayers for a long time. It's too early. Conditions aren't right, but boy, at the end of the year, it certainly seems like those folks that get out early do some good. I know that years ago, 2 or 3 years ago, Winfield Solutions had their big plot season, and they look at all kinds of variables, really hundreds of variables. And the one thing came down to that might be seed treatment, that might be variety that you plant. It may be depth that you plant. Number one determinant on yields, and this is 2 or 3 years old, was planting date. So we're seeing that more and more. I would be surprised if we're not buying some soybean acres here. That kind of agronomic advice of get the planter out early, typically, and this is not backed with any research, but I think everybody agrees to this. Typically, in a large part of the Corn Belt, we plant corn first. And if corn planting is going well, it's easy to leave the planter filled and plant that 80 or 100 acres more corn before you switch over. I think we're going to see a trend of change there where beans get planted on equal footing with corn in a lot of places. It'll take hold slower in Iowa and central Illinois, but I certainly see it in the fringe areas.
Oh, I would absolutely agree with that. The modern soybean plant is a marvel of engineering. Those things are so durable, your yields are so consistent. And while fertilizer prices have gotten a lot more friendly, beans are still cheaper to plant. And when you may be looking at a situation where you are probably looking at prices lower in the fall, planting the beans may make a lot more sense here.
Yeah. Sterling, you mentioned something here that some people may have questions on. We talked about the U.S. possibly supplying the global market, specifically China, with more soybean meal. Argentina, it looks like, it's just had some chronic yield problems down there. And I talked about being down there firsthand in June where it was really dry, and the drought never left. I know they've had some rains over the last 5 or 6 weeks, but to put this in perspective, I think that Argentina, you could say it's a disastrous crop on soybeans this year. But, and this is the great offset, 3-4 weeks ago, we still knew the acreage in Brazil was much larger. We thought that combined, the South American soybean crop would be about 18% larger than last year just because of the increase in hectares. But we're seeing that shrink as Argentine crop continues to really diminish. And now we're down to about 14%. And while that's a big drop, think about this, 14% more beans coming out of that southern hemisphere to supply the world is going to put some pressure on beans. Don't be surprised if that carryout number on beans doesn't grow despite really good domestic demand. Sterling just illustrated bean exports, maybe they slack off just a little. And then also, these processing plants, they're going to have to scrape every corner to make ends meet to try to get through the year. It's not because the demand's not there. It's because the beans aren't there is why that can grow. Yeah. So we're illustrating both old crop corn and beans as being, when you take out the unknowns, to a market, it really hurts its chances to reach the next level when it comes to price. And we're quickly taking out a lot of unknowns on this old crop market. So, Sterling, before we switch over to wheat, let's talk just a little bit about new crop corn, new crop beans, because we just came out of sales season. I think everybody might be a little disappointed on where those February averages came out on their projected price on insurance. Let's look and see what we might expect on corn and beans. But before I have you go through the chart, we've kind of picked on some places that are causing prices to be a smidgen lower. We picked on Ukraine, right? They've sent more into the global market than we thought. We picked on South America as a culprit for maybe putting a damper on prices because of the large increase in production area in Brazil primarily. We maybe picked on China not being as hungry for U.S. corn and beans as we have been. But Sterling, I tell this to the meeting, the number one, and it's a number one by a long margin. Okay, it's not a horse race where a nose wins. It's by a long way. The number one determinant of our prices going forward is what happens here in the United States. We're 3 of 4 years we have not made trend line yields on corn, and whenever the Outlook Committee came out with our yield, Sterling, hey, we've only got to have a record yield this year to create that excess that they're talking about. I think it was 180. Was it 181 and change?
It was 181 on corn, which we're getting to be a little bit like Brazil used to be with the soybeans. Brazil always predicted enormous crops. They finally hit one. 181 on corn means full fertilization. It means hitting the corners. And, I'm not talking you're pitching like Roger Clemens. You're pitching like Sandy Koufax. Okay. You really need everything to go right, or you can get the higher yield if you see fewer acres. That is the other possibility, meaning some of these marginal corn acres, well, these are just fine for beans. We plant beans on them. That's something we could see happen, and maybe we see those corn acres tighten up, and that's a way we could get to that number. That is a big number. We've never had a final yield north of 180, let alone 181. So that number is going to be a reach. And we missed that Outlook conference every year for the last at least 5. So
yeah, it's hard to put too much into that. And again, depending on how planning is going for the American farmer, they'll throw those plans, they'll throw those seed purchases out the window and keep planting what feels good to plant in a lot of cases. Now, having said that, we've got a March 31st report coming up. We're going to broadcast that live, if I'm not mistaken. and that's our prospective acreage report, the USDA. A degree of more accuracy than the Outlook Committee generally. And of course, that's followed up with a confirmation on June 30th. That's another one that we're going to do live. Now, those are fun reports, so make sure you mark your calendar for those. But between now and then, this market doesn't seem like it's got a lot of new crop fuel in it one way or the other, both positive or negative. When are we going to have to wait, Sterling, until we start seeing something fuel this market?
Well, this is a chart here of new crop beans, and saying it doesn't have any fuel is treating it kindly. The market is basically, we've shed about 86 cents an acre, and 86 cents a bushel since the February highs. And as you can see down here on the RSI, we have gotten oversold. Funds need a reason to buy this. They need a story. And right now, at this very moment, there isn't a story. And that is one thing that has kept this market a bit on edge. Along with it, we're seeing these great Brazilian crops. So no one's really going to want to step out here and take any risk, especially in a risk-off environment. So they're ditching their old crop and they're sitting on their money right now. Now, a couple of things can happen here. Go ahead, Bruce.
Sterling, you mentioned RSI. I want to jump in here real quick because I've got a text message on a question on that. RSI is a measurement that's been around since the 1970s. One of the universities, I believe, developed that. It's a momentum measure. And so it's a relative strength index. And the way I like to look at it is if in football you've got that fullback that just keeps punching up the middle, got those wide shoulders like Bo Jackson or Herschel Walker, and punches up the middle. They've got the momentum. The football team has the momentum. You guys have seen this, how football team just seems unstoppable and drives the field. This is a momentum measurement. Check this out. Look at that green line at the bottom of the chart. Beans have had momentum with the exception of two small times in June and July over the last year, okay? And they've dropped below that. Now, hopefully, they're resilient, and I think they are because the bean situation is extremely tight. And again, we've got to grow a crop in the U.S. Sterling, when can we expect that momentum to be at its strongest over the next 5 months?
Well, I would tend to think the first thing is we're going to need something to induce risk. Right now, the market is reaching this oversold level here, as we saw here and back here. I'd like to point out this point here, and I can put up a bond chart that'll make it look even more serious. But markets, once they have, usually, green is buy, red is sell, but we can stay down here in this bunker. We're going to need something to induce risk or to drive bean prices up. Number one, we have an infrastructure problem or an issue in Brazil, whatever it may be. That would be one thing that we could have. Two, we could have issues planting. That is the other issue. Is that going to happen? Right now, they've officially declared the La Nina is over and we've moved to a neutral situation in terms of the ENSO. That means most likely we're not going to have planting problems. So we're going to need, the first thing to get this thing to bounce is to induce risk. And then we have to start thinking about pollination with corn and pod setting for beans. So all of a sudden we're now looking at a situation for this that could stretch out into, from the middle of June to the middle of August, depending on where you're at with your beans and how soon they go in. So that's going to be something that is, and then there's one other thing. A noticeable drop in the dollar. That's the other thing that could induce risk on buying.
So Sterling, I've spent some time looking at this chart versus previous charts and really from October forward. I liken this a little bit to the 2000, and I hope the 2009 chart is one that I think we might be able to mimic. And if we do, what it shows is it shows a very, very good time for selling May, June, July. Now, I know Jason's on here, and Jason was a follower of the action indicators for a long time. And the reason we don't have those is they really were invalid for about the last 3 years. They triggered every day. And what those did, there were 4 tools that showed when was a good time to be a seller of commodities. Well, essentially what the action indicators have shown us is like over the last 36 months, every day was a good day to be a seller. But it looks like Sterling's pulled up 2009 in
We're
there.
getting 2009 right in here. Make it a little bit bigger. So right here is the start of 2009, and right here is the end of 2009. Here, I can
and if you look at corn, it's a bit more exaggerated, but let's follow these beans. Kind of an uneventful trade leading up to May and June of that year. Now, one thing that you'll notice, a precipitous drop right around July 4th. That's not a coincidence, folks. This June 30th report is a big deal to the market. Not just the report, but the timing of the year. You've got a 10-day forecast that's out. The majority of the Corn Belt is going to be pollinated by that July 10th deadline. I think we've really got to look hard at May, June, and maybe a little bit into July when it comes to forward contracting. If we see anywhere close to an average crop, a good start, good weather through that time period, we better be sellers, especially for the corn and beans that have to move to the market before the end of the year. And
Right.
This is kind of old school. This is a return to what Sterling and I have seen time after time after time. But it sure feels like, getting multiple chances to sell this crop, like those indicators have shown over the last 36 months, it may be behind us for a bit.
And one
an
thing,
average crop in the U.S. is going to be tough on prices.
and keep in mind, much like the end of February brings the March futures into delivery, the end of June brings the July futures into delivery, and that is the last hold that you have for the funds on old crop. After that, start moving to September, they don't like to trade that. It becomes a completely new crop situation.
Yeah. So the bottom line is we've probably been a little bit more negative than we should have been, but it's certainly the first time in months that we've seen how the market can make ends meet in regards to building up a substantial supply. But that supply, the number one determinant of it, if you leave this meeting with anything, has to do with America's ability to grow trend line crops over the next 6 months. It's going to keep the market on edge. We're going to transfer that risk from old crop to new crop slowly over the next 3 months. The dates that you need to look for on here, more so than price, it's these dates, June 30th, July 4th. I mean, I think that we kind of put a wall there. If we see things going relatively smooth in regards to the acres planted, not a lot of prevent plant, not a lot of excess flooding, we see weather forecasts look decent for 30 days. We got to really be thinking about selling. So Sterling, we've talked corn and beans. We need to talk banks at some point in time. And I hate to even have to pull up this chart, but can you pull up a Chicago wheat chart? I don't want to depress everybody, but can you pull one up?
We're going to pull up a Chicago wheat chart, and where there's life, there's hope. And we're going to pull this up, and if you read my Tech Tuesday, for the first time in a long time, I was, let me make this chart normal here.
Don't let him tell you he was super bullish. I read it. He had a hint of optimism out there, Sterling. Hint. All right.
A hint, a touch of optimism here as we pull up the wheat chart. This, as you can see, this oscillator and a couple others that I use, deeply oversold. We managed to bounce, a little bit of a bounce. We have a lot of crops, particularly in Kansas, that are still suffering under drought. If a farmer wants me to go drive down there and put the top down on my car, for a fee, I can arrange to do that and bring rain. But there is maybe we've beaten this up about as much as we've beat it up. The problem is it's very hard to get high wheat prices if you have corn and soybean prices waffling or edging lower. That's going to be the headwind. But if we see enough problems in the Ukraine and enough, maybe we can get a little independence out of wheat. But this chart has been, as you can see, the grind lower, and every bounce has gotten sold. And it looks like our little bounce that we had here at least today, it's a little bigger here, we are finding a little bit of pressure. And this right here, this is called a tweezer pattern. Computer algorithms will pick that up. They may not sell on it, but they're going to certainly cease and desist buying.
So Sterling, I got a question here, and it's about, is this a technical bounce? Is it a fundamental bounce? I think the answer is yes. And that question came in from Kentucky, and I think it's yes on both accounts. Fundamentally, Sterling just listed these things. Our carryout's traditionally low, and we can't really look at wheat carryouts like we look at corn and beans because we've got 5 classes of wheat we kind of throw together. It's just not apples to apples. But the bottom line is, net, our carryout in the U.S. is 60% of what we've become accustomed to long term. So we're short. We've got some HRW problems out west. We had a big problem last year, Ukraine. I really think that this Ukraine thing's got some wheels for a couple reasons. The Ukrainian farmer does some things different than the U.S. farmer in the fact that in the U.S., we rely on our seed and fertilizer and chemical business on a hand-to-mouth basis, almost kind of like just-in-time delivery. If I need a field sprayed, I simply call my supplier. They're out there in the field spraying within the next 3 or 4 days. That's not how it happens in Ukraine. You do have some Western companies that have stepped in years ago. I think Cargill invested in a company called Ukraland. But essentially, a farmer holds their supplies long-term before they're used. A lot of fertilizer backpacked in big back bags. They spread it themselves. Don't have to use a lot of phosphate. It's not quite as intensive as it is in the U.S. But in other words, they're prepared prior to planting the crop to grow it all the way through. Fuel on the farm. Another thing, if we run out of fuel, we're going to call the co-op and they're going to deliver. That's not how it works there. So you have to ask yourself, in Ukraine, are they as prepared to grow a crop this February as they were last? And I think the common sense answer is no. The other thing is, the war's ravaged a lot of this area. If 26% of this area, especially in the east, looks like a challenge to be farmed, those acres are probably not going to get planted in whatever they were going to get planted, whether that's spring wheat, whether that's the upcoming winter wheat, whether that's corn, soybeans. I think we may see the Ukraine effect actually take place. Even if fighting stops, I think the Ukraine effect may actually have a tail and lag here just a bit. So we got those fundamentals on our side. And then Sterling, like you said, you spelled it out very simply on Tuesday. I think I sent you an email later in the day. Tell us technically what we could be experiencing here too on wheat.
Well, with wheat, even though we haven't seen the CRT reports, we know there's a big short position, particularly in Chicago. We've seen from the bits of reports we've gotten that it's been covered in Kansas City. We have a big fund short. Some of this buying right here over the last 3 days, risk off buying. When funds are short and the manager comes, lighten up, you have to buy. So that is something here that has sparked a little bit of this. And again, the market deeply oversold. If we put up a stochastic by any indicator, it's oversold. So you combine these things, these fund managers like, I have money made, the guy's screaming at me to cut my risk, that produces some buying. Oftentimes when markets make bottoms, they tend to look like that, where you have a new set of circumstances to at least wash out the shorts. Then you can begin to set the stage for, some potential bullish action. Obviously the situation in Kansas is going to merit watching, and that's going to be something that's going to start developing here in the market fairly quickly as we start to see, we're going to start getting some yield ideas. And if they come in and they're problematic, that can spark some additional buying, especially when we have fund shorts in there. So from a technical point of view, we have become deeply oversold. If we put this on a weekly chart or anything like that, we have created a situation where we can get the first leg of a rally, or at least shake the market out. And again, if you're marketing wheat, I'm a big believer in increments. There's no guarantee that we're going to actually be able to recover and maybe take this thing back up. $8 would be really great compared to, $7 where we're at. Upside up in here, well, that's going to take a lot more to propel that.
So, I think as if we're talking to farmers, I think it's okay to say right now conditions are not conducive to make sales. No, we don't have a game plan. A lot of this wheat's going to come to market in the next 120 days, but it's probably not the best time to make sales. Sterling, we talked about funds being extremely long in corn and beans for a long time. We've got just the opposite story in wheat. We've got funds that have been short for a long time. And again, going back to those old action indicator days, our fuel tank is empty, meaning it's not a good time to be a seller. Instead, it's a good time to be a buyer. Now, here's what Sterling and I know. We know in Chicago, if we're looking at soft red wheat, we've got more shorts in the market than bushels of soft red wheat produced in the United States. Those sellers will come to the market and they will buy this back. But what Sterling and I don't know is we don't know when, and we don't know exactly how short they're going to get before they do that. But essentially, they'll come into this market and they will buy this market at some point in time. Sterling, any indication of when that could happen, or are we seeing a little bit of that right now?
It's already beginning to happen. A lot of that fund wheat, what funds do is they'll buy 2 corn and they'll sell wheat against it. That is part of it. And so as they're beginning to unwind that corn position, that's another thing that propels them to do it. The other thing is going to be the acreage report. And I've switched over here to Minneapolis wheat, to spring wheat. I'm picking up, I have a lot of friends in the Dakotas and Minnesota from my days back up in Minneapolis. I'm getting a lot of ideas that maybe we're not going to see as many spring wheat acres as we're used to. So if you combine that with problems in Kansas, a little smaller spring wheat crop, again, there's your story. There's your spark to get something going. And as you can see, the Minneapolis wheat, which does not have the fund positions and the fund participation like the other ones, we're also seeing, again, a smidge of a recovery. We're trying, and again, any recovery is going to be fits and starts. It's not going to be a V bottom. It's going to be chop, chop, and work our way higher.
So Sterling, may be unrelated, and I know we want to wrap up here and we want to talk about banks at the end, but boy, it's the market as a whole has an uncanny reflection to 2 leaders in commodity markets, and that seems to be wheat and cotton. They seem to kind of be a forecaster of where the larger markets maybe go on corn and beans. So we need wheat to really pick up here. It would be nice of wheat to find some strength, and I think corn and beans find it as well. Any thoughts on that?
Well, if we look at cotton, cotton has had this, it's been range bound forever, which when you're a commentator, when you get this sort of thing, this is the thing you dread more than anything. Go screaming higher, great, you got stuff to talk about. It tanks, you got stuff to talk about. When it putzes around like this, it gets hard sometimes. But as you can see, we had a really good day on Monday. We were limit
A
up.
limit up day, right?
Limit up day. But what we didn't see after any limit move, you need to see follow through. We didn't get it. Then we had yesterday and all of our twitching going on. And now here again, we're starting to leak down lower. We're breaking out of the range that we were in, which was 80 to 90. We're now at 77. And our next support for this is not until we get down to 70. Cotton's going to be an interesting market this year. The outlook forecast was calling for much improved yields and a bit of a shift in the balance sheet. That creates more risk because we were looking at, noticeably smaller acres. We're going to have acreage competition with cotton between cotton and soybeans. So if we start to see those cotton acres tighten up and along with it some less than perfect weather, this market could get interesting, especially if the economy is feeling at least a little bit better in the second half. My other concern about the cotton is a bigger macro concern. Retailers are still having trouble selling clothing items. Fashion is out of fashion. Farmer to me mentioned something really interesting at a meeting. Kids today don't care what they dress like and they don't care what they drive, which is a complete reversal of life in eastern Nebraska in 1983 when I was in high school. A complete reversal.
Yeah, I made mention, we talk about those driving habits. Boy, they have changed. And we did some numbers, Sterling, a couple meetings back on the number of gasoline gallons used in the U.S., and they're way down. And you're right. A good Friday night was 10 gallons of gas. And today, if my kids burn a half a gallon on a Friday night, it's a miracle. So we're into this thing over an hour, and we've got great attendance still. We've had some good stuff on here around. And when we talk about a European bank and Silicon Valley, we kind of think, you know what, that's a million miles away from us in agriculture. But if we look at these markets, you know, it seems if you could say there is a general risk-off situation that might affect something more than just equities, maybe more than some of our precious metals, things like that. How can Credit Suisse have anything to do with corn, bean, wheat price that we experience on a day-to-day basis?
Okay, so if we think about Credit Suisse is mostly an investment advisor. They're a fairly large Swiss bank. And if you remember this chart, I had this chart up for us once before, back when we saw the Ukrainian invasion. And this is a chart of credit default swaps. You do not want this to go up. This is the cost of insuring your debt against default. When these go up or the spreads blow out, that is when there's a sign of trouble. So this was back when we had the Ukrainian invasion and Credit Suisse first came into the news. And as you can see, versus the other big banks, this is BNP, SocGen, and Deutsche Bank. They're down here. They've been having a little bit of stress. But as you can see, Credit Suisse has exploded into the area where you're now trading at a level where default is now expected. How this affects agriculture. These banks, especially BNP Paribas and Rabo, are big international finance sources for agricultural lending. Your local bank may very well be doing their lending on a bit of a local basis, but they depend on some of these other bigger banks for capital, for funding, and for their operations. So this is one thing where it can create some nervousness. The worry in with SVB got in a situation where, let me pull up a chart here of the 2-year yield. There's a 2-year yield. What happened is they created a situation on their balance with their assets where they created too much duration risk. So, for example, I'm a banker. I have $100 million in capital. I deploy 20 million in 3-month bills, 6-month bills, 9-month bills, etc. They deploy too much capital out into this part of the curve out 2 years. When you do that, you're supposed to hedge part of this with futures. That can be expensive if the futures don't work, so you're going to have to give up a little bit of your yield, but you want to offset this because every day this is marked to market. When these rates go up, the value of those bonds go down, and suddenly you create a balance sheet problem. And these rates, they peaked right up here at 508, and they came all the way back down yesterday to 371. They did that in four days, which this is the biggest move I've seen on a 2-year since 2008. So that creates nervousness in the banking system. Then there's the piling on effect. We've seen stocks of banks that are perfectly good banks that have absolutely nothing to do with this get labeled a regional banking crisis, that the regional banks are having a problem. You combine this with ETFs, you have banking ETFs and things like that. All of a sudden they go no bid and get sold. You see all these stocks get slammed, and that creates nervousness in the market. Does the fact that SVB had their problem, is that any indication that PNC or Fifth Third has any of these problems? No, it does not. And the Fed has put in some things to backstop this. One, they're allowing them to deposit these bonds at par, meaning if I'm long the 2-year, I'm going to get my actual money set up against my balance sheet so I don't have the balance sheet problem. The other thing is the market is a natural healing mechanism. These rates got slammed back down hard, and when yields come down, those bond prices come back up, so that eased their balance sheets.
Good stuff. Good stuff there, Sterling. And I think that, if anything, you need to be discerning with where we do business, even if it's a small business, because there were plenty of small businesses affected by this move. If you had assets within that bank, if you had a loan within that bank, even. So, the decisions to do business with someone who's doing things right is the key. Not to sound like a salesman as we close this out, but I'm proud of what we presented over the last hour, and we work really, really hard daily on supplying you with information that is, in my opinion, second to none amongst insurance companies and easy to understand. So if you're a customer of ours, or if you've got customers, make sure that they're signed up for this daily email. Make sure that you get them on the podcast. The podcasts come out a couple of times a day. It's easy to get, and they're not scary. Once you're signed up, they're going to be sent to you just about like a text message is. So it's something that we put a lot of work into, and we're pretty proud of that fact. So Sterling, I appreciate you giving us the last hour and 8 minutes. For me, being a small farmer and also just really kind of a small investor as well, I've taken a lot of information that hopefully it makes your business stronger. Sterling, with that.